New segment focusing on the multi-trillion-dollar futures market, from stocks to commodities and also bonds. We're finding you the ways to trade tomorrow's trend today, and right now we're looking at an unusual trading pattern that's developed in crude. Could mean big moves in the coming months. Alex Steele is here for some Crude Trading 101. Alex?
I've been looking forward to this segment all day, Eric. So it involves sexy words like Contango and Backwardation. Contango means prices are cheaper now than in the future. Points to basically a well-supplied market. Backwardation, on the other hand, is just the opposite. Supplies are now more expensive than later deliveries, which can point to either short covering or tighter supply. Now, the U.S. is awash in oil, and it's trapped in the Midwest, and this has been pressuring the price, but that is changing. The discount on front-month futures has narrowed as more pipelines bring oil from the Midwest to the Gulf Coast. One of the most important, of course, being the Seaway pipeline, bringing as much as 400,000 barrels a day to the Gulf Coast, although right now it is operating below capacity. And this means refiners on the Gulf can use the oil typically stuck in the Midwest, which boosts demand and lifts prices. Bank of America is looking for backwardation in WTI later on this year, Eric.
Thank you very much, Alex. This is a great opportunity to bring in Phil Strebel, a commodities trader at RJO Futures at the CME, for more on how he's trading this emerging trend in futures. So, Phil, tell us, how are you trading it?
Yeah, so I agree with Bank of America that the backwardation is not going to continue, and we're going to end up with a contango. You want to look at the stats of the crude oil market. Current domestic inventories right now are at about 384 million barrels. That's our highest level in 21 years. Right now, we're producing about 7.15 million barrels per day. By the end of the year, we should be at 7.5, and into 2014, it's 7.75. To put that in focus, as last year, we only put out about 6.75. So our production is continuing to increase as time goes on. How are we doing this? It's because of our new technological advances. We've fracking, we've got horizontal drilling, and what proves that is that our dependence from Nigeria is at a 5-year low.
Hey,
so
Phil?
How would I trade this? Yeah.
Well, you're going to say, how are you going to trade that? So before we get to it, though, it's not just a supply issue, right? I mean, isn't it going to be a demand issue as well? Because Gulf Coast refiners can really only refine heavy oil.
Yeah, well, if you start looking at the demand side, I don't anticipate that demand picks up at all. I think the U.S. economy right now is quite stagnant. We're hearing about other countries around the globe, like China, having weaker economic data. Europe is having its own issues right now. So our production is continuing to increase, but our demand is remaining the same, if not actually sliding a bit.
So Phil, then give us the trade. What in your mind is the best way to make money on this?
Well, see, I would look at the front month crude because that appears to be the most overpriced in my opinion. I think that selling crude oil at the $97 range is a good entry point. You could get a nice tight stop above that weekly high, which is right around $90.24. What you want to do is you want to look at, down at 98.24 is your high. 90 is where my ultimate target is. I think your first sell-off is going to be down to 94 and some change. That's your 50-day moving average. Your ultimate target, and where I think crude oil really should be priced at, is right around $90.